Welcome to the October session of our CB and DC virtual seminar series. We have a new format this month. We have 4 candidates who will be on the job market this year, all of whom are working on issues related to digital currencies and central banking. Virtual seminar series. We have a new format this month. We have 4. Okay, so first, some ground rules. There's going to be each speaker will have 25 minutes. We'd ask that you only ask short clarifying questions during those 25 minutes since it's a short presentation. And then we'll have 10 minutes for Q&A. During the Q&A, participants can unmute themselves. Panelists can unmute themselves, but participants can enter questions in the Q&A box at any time. Okay, so with that, let's move straight to our first presentation, which will be by Shumiao Ouyang from Princeton University. Shumiao, take it away.
Okay, so can you see the screen?
Yes, looks good.
Okay, thank you very much. And thank the organizers for having me here and also my job market paper here. I'm Shumiao Ouyang from Princeton, and my research interests center on fintech, digital economy, financial intermediation, and household finance. So this talk is about cashless payment and financial inclusion. First, let me introduce the background about this financial inclusion challenge a little bit. It's widely known that it's quite hard to provide financial services to the underprivileged individuals, and extending credit access to them is even harder because the overhead cost is usually quite large compared with the small loan sizes. And also there are some severe information asymmetry between the lender and the borrowers. But recently, we see a boom of big tech credit in a global level, and it is also overtaking fintech credit in many places. And it's likely to provide some new credit to those who are not previously covered by the traditional banks. At the same time, we also see a rise of the mobile cashless payment, especially those provided by big tech firms like Alipay, WeChat Pay, Apple Pay, and so on. So these kind of mobile cashless payments naturally combine the important technological advancement, such as better data, better models, and more accessibility. At the same time, it has accelerated the shift from cash to cashless economy in a lot of places. And in China, even the beggars would print a QR code on their begging bowls to collect alms. So is this a coincidence, or does the information flow that comes from the cashless payment fuel the boom in big tech credit? So here's the research question. Has cashless payment facilitated the lending to the traditionally underserved? If so, then how? Although we see the joint rise of the digital payment and digital credit, it's just quite hard to establish some causal relationship between the two. Why? Because it requires an exogenous shock on the cashless payment activity. It also requires detailed individual level data on payment, credit, and so on. So I try to combine a natural experiment with rich administrative data from Alipay to solve these challenges. And I've actually spent more than 2 years physically in Alibaba just to work with the data. And here are the main findings. First, the cashless payment flow facilitates credit provision and credit take-up. On the extensive margin, using the in-person payment in amounts lead to the increase of the likelihood of getting credit access by as much as 56.3%. And on the intensive margin, if we exogenously increase the in-person payment flow by 1%, then the credit line is expected to increase by about 0.41%. So just from this number, we can see the magnitude is quite large. So why can this credit provision happen? I show that is because the big tech takes advantage of the information in the payment flow, and it is beyond the information in the credit usage or credit repayment. It is also beyond the enforcement power that comes from the access and management. And in my paper, I also estimate a simple structural model to quantify the information value of the payment data. And it shows that compared with a counterfactual case where the lender only knows the personal characteristics, if they also know the payment data to get more information about the borrowers, the credit line is expected to increase by about 57.7%. But due to the time limit, I will focus on the empirical analysis in this talk. And I also show that it's the financially underserved who benefit more from it. We see a stronger credit provision effect after digital payment adoption, but it focuses on the less educated and the older. Okay, so before going to the data, let me introduce two phenomena that are quite related to this research. The first is the rise of the cashless payment market. So here, I plot the US card payments transaction volume over its GDP in blue, and China's mobile payments transaction volume over its GDP in red. And we can see the patterns are quite different. For the US card payment is quite a mature market, and the transaction volume of the card payment is about 30% of its GDP in the past decade. But for China's mobile payment, in 2012, it was only about 4% of its GDP, but as of the end of 2018, it has become about 300% of its GDP. So we see the boom of the mobile payment in China. But this is not just for China. Actually, if we look at the other countries, it's also happening, especially when we compare it with the plot that I did about 2 years ago. We can see that a lot of the countries are catching up in terms of mobile payments. And the second observation is the rise of the big tech credit at the same time. So let me briefly introduce Alipay and the Huabei credit line, the two objects that I'm going to study in this research. Alipay is the largest mobile wallet in China with more than 1 billion active users. And the Huabei credit line is the virtual credit card provided by Alipay to its users, and that now has become the largest consumer finance product in China. In my representative sample of Alipay users, I find that about 72% of them have access to the Huabei credit line. And people do use it a lot. Among those with Huabei access, about 95% of them have used the credit with an average monthly usage of about $80, which is roughly 20% of the average disposable income in China. And people do use it. And also, it's likely to provide some new credit to those who are not well covered by the traditional banks. So even among those who do not have a credit card on file, we can see that about 64% of them have access to the Huabei credit line. So from these numbers, we can see it's quite inclusive already. In terms of the data, I get the representative random sample from the whole population of Alipay users, and it contains about 41,485 users with in-person cashless payment activities. It's individual level panel data at monthly frequency, and it contains detailed information on not only their personal characteristics, but also their payment, credit, investment, and many other relevant digital footprints. The sample period covers about 41 months from May 2017 to September 2020, during which period both the mobile payment and bag sharing industries developed quite fast. So you might be wondering, why am I talking about bag sharing industries? Because it's critical to my identification strategy. So basically, I use the placement of Alipay bundled shared bikes as the instrument for the in-person Alipay payment. And for the Alipay bundled shared bikes, it's a bikes that you can directly unlock with Alipay's scan function. You just scan the QR code on the bike with Alipay, so you can use the bike and then you can ride it anywhere. And with exactly the same scan function of Alipay, you can also scan the QR code of the local merchants and make some in-person payments. So that's why we expect to see some nudge effect there. So when people start to use the bikes, they will also start to use the in-person payments. And next slide, I will show some direct evidence about this nudge effect. So here we're doing event study. The event we're looking at is the adoption of the bike, and the target variable is a log 1 plus x transformed in-person non-bike payment flow. So we see that right after the bike adoption, people start to heavily increase their non-bike payment flow, although this non-bike flow has already excluded the bike-related usage fees just to avoid the mechanical effect. So we see the effect on the non-bike payment flow is both large and persistent. And next, I will show some evidence to support the validity of the instrument. First, I will show some evidence about the relevance condition, and then I will talk about the exclusion restriction condition. For the relevance condition, we are expected to see a very strong correlation between the bike placement and the in-person payment flow. And that's what we see in column 1. So when there are more bikes placed in the city, people living in the city tend to increase their in-person payment flow. And I guess what's more interesting is in column 2, where we further separate the Alipay users into the bike users and the non-bike users, and we're only seeing this effect of this bike placement on the bike users' in-person payment, but not on that of the non-bike users. Well, it might be surprising at first sight because it's so easy to become a bike user. So in my definition, as long as you have used the bike at least once during the whole summer period, then you are a bike user. So it's quite surprising. But after second thought, it actually makes a lot of sense. Imagine you are a person who do not know how to ride a bike. Then no matter how many bikes are placed around you, your behavior might just not change. So in that sense, this result also supports the nudge story. So basically, when you are a bike user, you are starting to be affected. Otherwise, you won't be affected. We can also see that this story is kind of consistent in the intensive margin, on the intensive margin in column 3. So here we only focus on the bike users, and we see that it's after their first bike usage that the bike placement start to have an effect on their payment flow. And the timing of the first bike usage itself does not explain the payment flow very much. And then I will talk about the exclusion restriction. The first column just shows some reduced form result that when there are more bikes placed in the city, people living in the city tend to have higher credit line. And one common concern is that there could be some factors that are correlated with everything. For example, some local growth potential or local infrastructure plan. So it can be correlated with the bike placement decision of the bike sharing companies. It can be also correlated with the credit provision decision of the big tech companies. So in column 2, we again separate the Alipay users into the bike users and the non-bike users. And we're only seeing the effect of the bike placement on the credit line for those bike users, but not the non-bike users. If it's about these kind of common factors that are correlated with everything, then we are expected to see that it's correlated with everyone's credit line. But we're only seeing the correlation for the bike users, so it kind of help us to rule out these alternative stories. And column 3 is another robustness test. It just shows that it's after the bike adoption that the bike placement start to have an effect on the credit provision. I've actually done many other robustness tests, but due to the time limit, let me skip them for now. So now I hope I've convinced you that the bike placement is a good instrument for the payment flow, and then we can do the AV analysis. So in this table, we use the bike placement as the instrument for the in-person payment flow, and we show the first stage result in panel B, and then we see the causal effect of the in-person payment flow and the credit provision in panel A, where we show the second stage result. And in panel C, we just shows the corresponding OLS estimations. So different columns just focus on different specifications, and we just look at the measures on different margins. For example, in columns 1, 2, and 3, we focus on the extensive margin of this credit provision. And in columns 4, 5, and 6, we focus on the intensive margin of this credit provision. So the credit access is a dummy variable indicating whether this person have access to the credit in the current amounts. And the log credit line is just a log transformation of the credit line if the credit line is larger than 0. And we also look at different margins of this in-person payment flow. For example, in columns 1 and 4, we use log 1 plus x transformation, which captures both the extensive margin and the intensive margin, but is a little bit hard to explain. So in columns 2 and 5, we only focus on the extensive margin of the in-person payment flow. And in columns 3 and 6, we only focus on the intensive margin. But across all these specifications, the message is quite consistent. In panel B, we see that the back placement has always been a quite strong instrument for the in-person payment flow. And in panel A, we see that with some exogenous increase in the in-person payment flow, the credit line is expected to increase on both the extensive margin and intensive margin. So we see the credit provision happens, and we might be wondering why it can happen. So here we look at the potential channels. So potentially the lender knows more about the borrowers by getting more information from the payments. And information can come from a lot of places. It can come from the transaction data itself. It can also come from the credit usage and the credit repayment. So to separate those two, we categorize the payment flow into the non-credit payment flow and the credit payment flow. So the non-credit payment flow are just the money that people pay with their own money. So it has nothing to do with the credit usage or credit repayment. But even if we only focus on the non-credit payment flow, it still has quite a large effect on the credit provision on both the extensive margin and intensive margin. And the effect doesn't change much if we add the credit payment flow as a control. And we might be wondering that the enforcement power of the big tech credit might arise if we use the digital wallet every day. For example, if we do not repay on time, then potentially the platform can just freeze our account or forbid us from using our assets under management. So in panel B, we use the assets under management as a proxy for the collateral and add it as a control. But even after that, we still see that the in-person payment flow has quite a large effect on the credit provision, and the magnitude doesn't change very much, actually slightly higher than the previous estimate. So this table just shows that the transaction data itself can have a lot of value. So this is different from the credit usage and credit repayment information that which is a foundation of the business model of the current credit bureau. So it shows that the transaction data itself can already be quite useful. And we're also quite wondering like whether people use the credit and whether people use it for good. So in these slides, we try to look at the take up of the credit by looking at the virtual credit card share in both the in-person transaction settings and also the online transaction settings. And indeed, we see that with the increase in the in-person payment flow, people tend to have more credit usage in both the in-person and the online environments. So this can be a result of learning by doing effect. It can also be a result of the increase in the credit provision. And in terms of the whether people are using the money for good, we might be worried that when people get some cheap credit, they might use it for games, cigarettes, and so on. So since I have access to the very detailed transaction level data, so it allows me to categorize the spending into the compulsive spending and the non-compulsive spending. So the compulsive spending are the ones related with games, cigarettes, alcohol, and so on. But we do not see that the in-person payment have a significant effect on the consumption structure. although we might see a shift in the consumption level. And the last part, we focus on the heterogeneous effect of these credit of these digital payment adoption. And we might be wondering that with more precise information from the payment data, whether it will lead to more credit provision to the less creditworthy. Well, actually, it might not necessarily be the case. And I will show the intuition with a simple theoretical example. So just to be clear, this is based on a simple economy where there's a monopolistic lender and also a bunch of borrowers with different creditworthiness. And this quite specific environment is also, and these plots are given by specific parameters. And I'm just using this to show the intuition. So here I plot the optimal credit line provided by the lender to the different borrowers with different creditworthiness. And we look at the 3 stages of the borrower's adoption of the digital money. The first stage, people are just cash users, so they're not using the digital money at all. And here we just assume that the lender does not know any information about the creditworthiness of each borrower. And it will just decide not lend to anybody. And in stage 2, people have become the new digital money adopter. And here we just assume that now the lender knows whether the creditworthiness of each borrower is above a certain threshold. Now we just make it 0.25. And in this setting, the lender will decide to lend to those who are above the threshold, but not lend to those who are below the threshold. And now let's look at the stage 3, which is shown in the red line. And now people have become a digital money user. So in the stage 2, people are just the new digital money adopter. So they just submitted their personal characteristics information. So that's why the lender knows more about them. But now, since they are a digital money user, they use the digital money every day. So in addition to these kind of personal characteristics, the lender also knows their consumption behavior. So here we just assume that now the lender knows the exact creditworthiness of each borrower. So the optimal credit provision will shift from the blue dashed line to the red solid line. And we can see that for the really high type group, they will have an increase in their credit line. But for the ones who are relatively less creditworthy, previously they can get some credit line, but now they get 0. So in that sense, they're actually worse off. But I have to admit, this result is given by quite specific parameters. And for this scenario, we call it financial divide because some of them are better off, some of them are worse off. And actually, it can also lead to financial inclusion. So in the panel B, the only thing that I change is to change the parameter from 0.25 to 0.8. And we can see that for the really high type group, on average, their credit provision is the same. But for the ones who are relatively less creditworthy, they actually get higher credit line. So from the example, we know that actually the theoretical models can predict a very different result. It can be a good news for the less creditworthy. It can also be a good news. So we really need to look into the data and see what's happening. So firstly, we need to categorize people into different groups, and we need to know who are the financially underserved. In this slide, I just use my data to confirm a traditional view in China that it is the less educated and the older who tend to be financially underserved. And indeed, we see that they tend to have lower financial service usage and also lower financial literacy because they have fewer linked debit cards, lower maximum assets and management, shorter investment experience. They're also less likely to pay with their real name, less likely to use their own account, or less likely to have a complete profile. So let's separate people by their education and see whether the effects of the digital payment adoption are different on them. So in columns 1 and 3, we'll only focus on the less educated group. And in columns 2 and 4, we only focus on the more educated group, meaning that they have a college degree or above. So in panel B, we see that the first stage result is pretty strong for both groups. So the compliance is there for both the less educated and the more educated. But in panel A, we see that the effect is only there for the less educated group, but not there for the more educated group. So in that sense, it helps us to support the financial inclusion story. Okay, so let me conclude here. In a nice review by Berg, Foster, and Puri, they raises 2 open questions. The first is the information from the payment flows a causal factor behind the credit expansion? And the second is, does it benefit customers previously underserved by the traditional financial institutions? And my paper tried to combine unique data and a new identification strategy to answer yes to both questions. And this is also the first paper showing the payment information fuels big tech credit to the household. It also has important policy implications. The mobile payment can potentially be the new financial infrastructure and provide new opportunities for sustainable and inclusive finance. Okay, thank you.
Okay, thanks very much, Shumiao. Very interesting. So we've got a sizable group of panels. So why don't we raise your hand if you want to ask a question? Yeah, you go ahead.
Hi, Shumiao. This is very interesting. I have a question. How can you distinguish information from punishment? So if you see I have more transactions, that reveals information about me, but at the same time, that means I really like this payment method a lot. If you exclude me from it, that's a big punishment to me. So there is a question, how would you distinguish these two? Or is that even possible?
Okay, so thank you. This is a great question. And I have to admit, I can only partially address it. So this is kind of, so the punishment is kind of related with the enforcement power of these big tech firms. So what I did is just to use the assets and measurement as a proxy for the collateral. And we see that even when added as a control, the effect doesn't change very much. Actually, the effect is slightly larger. So meaning that at least it does not come from the enforcement power in terms of the assets and the measurement. But you are right, the platform can potentially punish the consumers in other different ways. And it might be the case that the consumers just feel that they just can't live without the platform. So this can kind of increase the enforcement power, but it's something that we cannot directly observe in the data. So yeah, so that's there are some limitations, and I can only partially address this concern. Thanks.
Okay, thank you.
Thanks. So in the interest of time, maybe we'll bundle the next set of questions. So I'll have people ask questions. Shumiao, you can take some notes and then try to address them together. So Zhu, go ahead.
Yeah, so my question is, what exactly the mechanism here? You showed, I think it's funny, very sensible that you show the non-banks access to payment data can improve their decision of making credit and improve the financial inclusion. My question is really about the key thing is here is the information on non-bank. So if the payment information is so valuable, would that you would say if the bank have access to the same information, would that do the same decision to extend credit to the underserved population? Or because of like Alipay is a non-bank, so it's less regulated, so the cost is much lower, so they can do that. So that has the implication how your result can be generalized to other scenarios, right?
Okay, thanks. So let's get to Charlie.
Thanks. You have used the issue of the using the monies for making bad or inadvisable purchases. I'm wondering whether you can turn that around and do part of the information gathering on that same thing. Is it the case that people who use their Alipay for cigarettes and gambling are also going to get lower lines of credit, and because that would help untangle whether there really is an informational story here.
Okay, thanks. Scott?
Thank you. It's very interesting. I just have 3 comments, 2 of which I think have already been said, but 3 things that I would appreciate hearing more about in the presentation and paper are, one is the issue of the endogeneity of the bike use. I know the sample is not exactly representative, but there seems to me there might also be a selection effect as to who's riding the bikes. At least in my perception, that might not be a select group that may have an impact on the credit provision. Second thing, just to affirm what Zhu said, is the results are strikingly similar to what we've known for decades about early monitoring and credit screening by banks and their monitoring of payments. And so it would be helpful to know what do we learn that's different or better or insightful beyond what banks have already kind of known proprietarily. And the third thing is to think about whether the credit provisions, how does that fit into an optimal lifetime consumption path? Is this providing more credit that is allowing them to buffer against income shocks and therefore raising lifetime utility by smoothing it? Or is it enticing people who are maybe impatient to overborrow? So some discussion of those 3 things I think would strengthen the presentation and paper.
Okay, and Russell?
Yeah, I think it's super promising data set. It's super interesting. Thank you. So I will be quick. So I think for people, lots of people are in the central bank in this audience. It might be good to know the real impact about having access to credit and credit line. So I think one thing might be we can measure is whether the guy have access to the buy and they have access to credit line. So it is that they have also consumed more later on. So it's something we can measure. So they might be good to see something like that. So and then also the amplification mechanism. So after they spend more, they may also get more credit. So whether we see this amplification mechanism is happening in the data. And the second question is about execution. So how exactly Core B is work? So is Alipay, they partner with one of the bank, it's like Amazon and JP Morgan Chase. So Amazon don't issue credit card, it's JP Morgan Chase issue credit card. So maybe a lot of screening or having access to credit actually go through the bank, but not the payment side. I don't know. So just some institutional detail, maybe you can explain a little bit. So the last thing is similar to what Charlie mentioned. Maybe not just the type of the payment method, but maybe the size of payment method, right? Because now if I see you're a big spender, so I may be more likely to extend credit to you. So do we see something like that in the data? Thank you.
Scott, did your hand go back up or? No. No. Okay. Okay.
Sorry, no, I forgot to take it.
Just wanted to be sure. So Shumiao, you've got like 1.5 minutes to respond to all of that. So you can say whatever you like at this point, however you want to wrap things up.
Okay, thank you, Todd. So for Zhu's point, about whether it can be generalized. So I guess the mechanism can be the same for many other traditional banks. For example, if one bank provide a debit card to the consumers other than the other banks, then potentially these banks can provide better credit than the other banks who have the same access to the credit bureau data. And for Chinese point, that's definitely a great point about whether we can use the more detailed transaction data to see whether the credit line responds to the different types of consumptions. And I will look into it later because my data can allow me to do this. And for Scott's concern about the endogeneity issues there, I've actually done some tests in the paper, but not presented here. So I've done some selection issues about who are the back users and also whether the same thing would happen for those who have used the bikes only once. And actually the result is basically there for the one-time back users. So it can help rule out many alternative stories. And for the lifetime consumption path, that's definitely a good point, and I'll try to address it more in the future. And thank you for bringing this up. And for the Russell's point, I yes, we do see that when people get a credit, they will consume more, and you're right. Potentially, we can also link the size of the individual transactions to the kind of the credit provision to them, and that's something that I haven't looked into. But for the future research, that's definitely a good direction. So thank you all for all the great suggestions.
Okay, thanks, Shumiao, for an interesting presentation. Thanks everyone for those great questions. And I hope that you'll feel free to anyone else who has questions to contact Shumiao directly. So with that, I'll turn over the moderating duties to Jonathan for our next paper.
Yep, thank you. So our second presenter is Remo Nyffenegger from University of Basel. So Remo, please share your slides. Remo is going to talk about central bank digital currency and bank intermediation.
Yes, great. So first I want to thank the organizers for putting my paper on the program. I followed this seminar quite closely over the last 2 years. I think that's one of the good things of COVID, that we have these online seminars. So I'm very happy to be here and present. So as Jonathan said, I'm going to present a paper about central bank digital currencies and bank intermediation with heterogeneous bank deposits. So what I talk about in the paper is a CBDC that is can be held by the general public. So I'm going to talk about the retail CBDC. As most of you probably are aware of, there are also caveats when we talk about the introduction of a CBDC. And one caveat being the effect it might have on bank intermediation. What's kind of the line of argument here? Well, deposits currently are a cheap way of funding for banks. And if the central bank introduced a CBDC and the people in the economy might see it as a substitute for bank deposits, then we might see a crowding out from deposits to the CBDC, and then there will be less funding for banks. And if there's less funding, there might be less bank lending. This might reduce credit availability, could increase credit costs, and hence might have real effects on the economy. Hence, we might be really interested to think about this problem and analyze it, how big it is. And so that is my first research question. Does the introduction of a CBDC lead to disintermediation of banks? And I answer this question by building a tractable general equilibrium model based on the one hand on a new monetarist model in line of logs and right, and on the other hand, ONRG environment in line of logs. So I'm obviously not the first one who thought about CBDC and bank intermediation. There is also people in the panel. Jonathan has a paper, Todd and Daniel have a paper on that as well. So let me tell you what my main contribution of this paper is, and then come to my second research question. So if we think about the effects of a CBDC, they might differ depending on the design, how the central bank designs the CBDC. We might think about different designs. They could limit the amount of a CBDC that people can hold. Central bank could limit the number of transactions, or there's also a proposal by Binside that we could have different remunerations depending on the amount. And for example, here, Fabio Panetta, who is an executive director of the ECB board, talks about this remuneration example and then mentions that we should ensure that CBDC is a means of payment that is as attractive as cash, but we should reduce the attractiveness of the CBDC as a store of value. So it seems like policymakers, they care about whether the CBDC is held only as a payment vehicle or also as a saving vehicle. So why is that relevant when we think about CBDC and bank intermediation? Well, if the CBDC is only used as a payment vehicle, it might mostly be a substitute for liquid transaction deposits. And if it's also held as a saving vehicle, it might also be a substitute for saving deposits. And this effect, this difference between whether people hold the CBDC as a payment vehicle or also as a saving vehicle has not been studied that deeply yet. So I want to bring more depth to the analysis here and have a look at this question. So my second research question is, how does the introduction of a CBDC differ depending on whether it is held only as a payment vehicle or also as a saving vehicle? And then I first have an analytical part to get some qualitative results where I solve my model. And then I also want to get some numbers. I want to get quantitative results. And for that, I calibrate the model to US data. So that's basically what I do. And let me give you a preview of the results. So what do I find with respect to the first research question? I find that there is no effect on bank lending if banks hold voluntary reserves. So if we are in an excess reserve environment, and that's kind of straightforward. If we have an outflow in deposits, then what happens is basically just that first the excess reserves are reduced, and hence we have no effect on bank lending. However, I find that if we have an introduction of a CBDC and we have some shift from private money to public money, so from deposits to the CBDC, and we have no excess reserves, then bank lending will decrease. With respect to the second research question, I find that if there is a preference shift, such that 10% of the agents switch from transaction deposits to the CBDC, that decreases bank lending by about 1.2%, and the effect is almost 3 times stronger if CBDC also crowds out saving deposits, where I find a decrease in bank lending of about 3.0%. So as I said, there is already some literature on CBDC and bank intermediation, but my main contribution is adding this depth with respect to whether the CBDC is used as a payment vehicle or also as a saving vehicle. Okay, so let me give a quick outline of the presentation. So I'm now going to give you an intuition of the model. I'm not going to show you the math and equations. If you want to see something, I have everything in the appendix, but for today, I'm just going to give you the intuition. Then I'm going to tell you how I introduced the CBDC in the model. I'm going to show you some analytical results, and then I'm going to show you one calibration results. There's more in the paper. For today, I'm just going to show you one major result. Then I'm going to conclude, but let's start with the model. So in the model, there's different types of agents. On the one hand side, there is entrepreneurs, and the entrepreneurs, they have an investment opportunity, but they cannot work and they have no endowment. So somehow they need to acquire a good that they can then invest. And this investment then yields a return later. Then on the other hand, there is consumers. The consumers, they can work when young, but there is some timing friction. So actually what they want to do is they want to consume later in life, but later in life they cannot work anymore. So they can only work when they're young, but do not want to consume there, and want to consume later, but cannot work anymore. So what do they want to do? They want to get some assets to shift consumption over time. Now, there's 2 types of consumers in the model. There is an early consumer, and this early consumer will demand as an asset a medium of exchange, and there is a late consumer who consumes later, and this late consumer will demand as an asset a saving vehicle. You can think of that a bit as like this type of the model. You can think of it a bit as a diamond and divot environment, not the whole model, but only this part, but there is no uncertainty here. So this kind of organically gives me a demand for a medium of exchange and a saving. Then on top of that, agents in the model have a preference over public and private money. So in other models, how demand is generated for both is sometimes that we assume we have different types of meetings, and in different types of meetings we can only pay with cash or only pay with public money, etc., and private money, etc. So what I do is I assume that there are heterogeneous preferences of the agents, such that some want to hold private money, which is bank deposits, and some want to hold public money, which is cash or then later CBDC. These heterogeneous preferences are also dependent on the interest rate differential of the 2 types of assets. So you have a preference over one of the assets, but if the interest rate differential is big enough, you might still choose the other asset. So let me give you a quick example. If, for example, you slightly prefer public money over private money, so you slightly prefer, for example, cash over deposits, but deposits pays like a 4% interest rate and cash does not pay anything, then you still might want to hold, deposits, right? And that kind of, what's nice about that is that that kind of shifts agents from one asset to the other one, depending on how the interest rates are set. Exactly. So I have these 2 types major ingredients in the model. There is the natural demand for a medium of exchange and the saving vehicle, and then a demand for private money and for public money. Now, what do we have so far? We have these entrepreneurs. These entrepreneurs, they want to get this good, but they cannot produce themselves, but they want to invest it. And the consumers, they can't produce this good, right? The thing is that the consumers cannot lend directly to the entrepreneurs because by assumption, they cannot enforce repayment. And hence that gives rise to intermediaries, which is banks. So we have banks in the model and they basically intermediate between entrepreneurs and consumers. So what happens? An entrepreneur goes to the bank. At the bank, he says, hey, I want to have a loan. So the bank creates a loan. By creating a loan, he credits the deposit account of the entrepreneur. And the entrepreneur can then use these deposits to go to the consumer and purchase the good from the consumer. He can then invest the good, and this yields a return. And with the return, he partly consumes it and also pays back the loan. So that's basically what banks do. Then by assumption here, I assume that there is a perfectly competitive deposit market and an imperfectly competitive loan market. I do that because I want to have some imperfect competition in the model, because you see that the results are quite interesting if I do that. And I assume this perfectly competitive deposit market because it keeps the model more tractable, because I have two types. Okay, so now let's come to these two types of deposits. In the model, I exogenously assume that there is a minimum reserve requirement on all the payments that are done from these early consumers. So we only have the minimum reserve requirement for the early consumers. That's also how it's done in reality, right? We have only a minimum reserve requirement on liquid deposits, but not on illiquid ones. Now, because we have that only on liquid ones, it is actually profitable for the bank to offer two types of deposits. The bank then wants to offer liquid transaction deposits that are going to be held by the early consumers, and the bank will want to offer illiquid saving deposits that are going to be held by the late consumers. Why is that? Because saving deposits, they can be invested one-to-one into loans, which they have some profit margin on, but they also want to offer the liquid transaction deposits because there is some demand from the early consumer. Okay, so that's basically the setup of the model. And now let me explain you how I introduced CBDC in this model. So as I said before, first I want to say that I only talk in this presentation about non-interest-bearing CBDC. In the paper, I also talk about interest-bearing CBDC, but for now, for this presentation, I only talk about non-interest-bearing CBDC. So what I basically assume is, or what basically the policy experiment is, that upon the introduction of a CBDC, there is a preference shift between private money and public money. So the prior assumption would, I guess, be that upon the introduction of a CBDC, some agents would switch from private to public money. You can think of that as some person wanted to hold public money, but also likes to pay digitally. That was not possible so far, but now with the CBDC, that's possible. So this agent now might have a strong preference for public money. So basically, the policy experiment is you have a preference shift from private money to public money upon the introduction of a CBDC. What I do not do, I want to emphasize that I do not state how many people will switch from private to public money. I just state, given that there is a certain preference shift and there is a certain switch from private to public money, what is the effect on bank lending, and what is different effect on bank lending depending on whether people only switch from liquid transaction deposits or whether they also switch from illiquid saving deposits to CBDC. Now, first to the analytical results. Here we need to differentiate two cases. The first case is whether the constraint is non-binding. So the minimum reserve requirement constraint is non-binding. That means we are in an excess reserve requirement, in an excess reserve environment. Here I find that there is no effect on bank lending. Why is that? Already mentioned that in the introduction. The banks here hold an optimal loan amount, and if there is a shift in deposits, so for example, if there's an outflow in deposits, first the excess reserves will adjust, and hence there is no effect on bank lending as long as we are in this excess reserve environment. Now, the more interesting case is if the minimum reserve requirement constraint is binding. What I want to give the example here is if we think about a preference shift from private money to public money upon the introduction of the CBDC. So we have this underlying preference shift, and that means that basically triggers a switch from private money to public money. And that means that this fraction here, alpha D, which is the fraction of early consumer holding transaction deposits, decreases. So the fraction of agents holding deposits decreases. And here in the first row, I'm only talking about the case where we only have a shift in the preferences with respect to the payment vehicle. So people only switch from the liquid transaction deposits to the CBDC. And let me talk you through the table to explain to you what happens and what I show analytically. So first, straightforward, because there is some people switching from private money to public money, from liquid deposits to CBDC. there is on the extensive margin a decrease in the transaction deposit amount. By assumption, there is no effect on the saving deposits, but now because the banks, they have some profit margin, they will increase their interest rates, right? They will increase their interest rates. And why do they do that? They do that because by increasing their interest rates, they attract some deposits on the intensive margin. Now, what's different to other papers that have thought about this as well so far is that here, the banks can not only have this intensive margin effect on this transaction deposits, but they also have this intensive margin effect on the saving deposits. And now, because they have this intensive margin effect on the saving deposits, they can partly compensate this outflow in transaction deposits. Now, what I can show is that bank lending here always decreases, but because we have this compensating effect, the outflow in total might not be that bad. Then the second row is if we have both, if we have a preference shift from both liquid deposits and illiquid deposits to CBDC, what happens additionally is just that we also have an extensive margin effect on the saving deposits. Exactly. Now, we have some analytical results, right? But we don't know yet how big these effects are. So now to get some idea how big the effects are going to be, I want to calibrate the model to the data. So for that, what do? I calibrate the model to the US economy from 1987 to 2006. I choose this time period because I want to analyze the model in the binding constraint environment, right? Because I mean, sure, we are currently in excess reserve regime, but as you've seen before in the excess reserve regime, the results are quite straightforward. There is no effect on bank lending. So what I want to do to also differentiate the effects with respect to the payment vehicle versus saving vehicle, I want to analyze the model when the reserve requirement constraint is fine. So what do? I consider only cash held in the US because we know that a lot of dollar is held abroad, right? And since I want to match some fractions between cash and deposits held domestically, etc., I want to control that. I assume that the $100 bills are used as savings and all smaller bills are used as payment vehicle. And then, as I said, I match some fractions and some other means. With respect to the data, to get some bank data on interest rates, etc., I derive that from data from SC call reports and from more standard time series I use. Okay, now I'm only going to show you one slide today with the calibration. I have more stuff that I do in the paper, but for today, let me just show you this main result. What we have here is we have a preference shift upon the introduction of a CBDC, we have this preference shift between private and public money. So, and we saw before that this preference shift that changes this fraction of agents holding this fraction of early consumers holding transaction deposits. Now, here at the red vertical line, we are in the calibrated equilibrium. Now, if we here go to the left, that means we have an underlying shift from private money to public money upon the introduction of a CBDC. And that decreases the fraction of agent holding transaction deposits. If we go to the right, we have exactly the opposite. We have an introduction of a CBDC, and just to keep it general, we could assume that this also triggers a shift from public money to private money, and that would mean that here the fraction of early consumers holding transaction deposits increases. Okay, so that's the setup here. And now, what do we see? So here the straight line is the amount of transaction deposits. As expected, the amount of transaction deposits decreases upon the shift from private money to public money because CBDC is introduced. Now, interesting now, and again, what's different to the other papers is that additionally, because we have these two types of deposits and the banks increase the interest rate, on the saving deposits, we will actually see an increase on the intensive margin. So the banks increase the interest rate, it can raise more funds on the saving deposits, and hence this compensates the outflow and transaction. And thus the overall effect on bank lending is actually not too bad. or I mean, that's relatively sad, but now on the right-hand side, what do we have on the right-hand side? On the right-hand side, we have both a change with respect to the payment vehicle and also with respect to the saving vehicle. So if we are here in the calibrated equilibrium and we go to the left, that means that agents switch from liquid deposits to CBDC and from illiquid deposits to CBDC by the same percentage. So there is an underlying equal preference shift such that the fraction of agents switching is equal. Now we see that there is also a decrease in the transaction deposits, but as well there is a decrease now in saving deposits because people also switch away from saving deposits. Now, one other thing that I want to mention is that you see that here on the right-hand side, the decrease in liquid deposits is not as big as the decrease that we see here. Why is that? Well, here, the banks cannot compensate the outflow in transaction deposits with saving deposits, and hence they increase their interest rates by more. And because they increase their interest rates by more, we see that the outflow here in transaction deposit is not as big as it is here. So that's one interesting observation. But still, because we have both an outflow in transaction deposits and in saving deposits, the overall effect on bank lending, as you see if you compare these two pictures, will be bigger. If you want to have some numbers, if we are at the calibrated equilibrium and we go to a situation where 10% of the agents switch from transaction deposit to CBDC, then bank lending increases by about 1.2%. Where if we are at the calibrated equilibrium and we have an outflow of both or a crowding out of both from liquid deposits and from illiquid deposits to CBDC, then bank lending decreases by about 3.0%. So we see that these effects are stronger. So policymakers might be interested in really thinking of how should we design the CBDC and whether, depending on how we design it, whether people will start holding it as a payment vehicle or also as okay. So let me conclude. What did I do? I built a general equilibrium model to analyze the effect of the CBDC on bank intermediation. I differentiate the effect depending on whether the CBDC is used only as a payment or also as a saving vehicle, which is kind of my main contribution of the paper. And I find that there is no influence of a CBDC on bank lending if banks hold voluntary reserves. So if we are in an excess reserve environment. However, if banks do not hold excess reserves, then we find negative effects on bank lending, and the numbers I've just told you. So yeah, so here I want to conclude, and thanks for your attention, and I'm happy to take questions.
Thank you very much, Remo, for a very interesting paper. So maybe at this point we can open up for Q&A, and I saw a few hands raised already. Maybe we can start with Mohammed.
Okay, thanks, Remo. So that's very interesting. So I'll try to be quick. So my question is more, or maybe comment, I don't know, is about the terminology that you're using in terms of the store of value. As long as I can, as far as I can see in the model, so there is no intertemporal decision in terms of saving. So the two types of deposits are, and correct me if I'm wrong, maybe I'm wrong. The two types of deposits are different from the perspective of the bank in terms of basically whether they are stable or flighty, I would say, right? Because one of them are kind of subject to reserve requirement, one is not, but basically both deposits are spent before you go to the next CM, right? So there is no intertemporal decision, if I am right. And in that sense, so and why this is important, because if there is intertemporal kind of substitution, then that's different from the liquidity channel that we usually see in the new monetary models. And I think you don't have that intertemporal decision. So if that's correct, maybe that would be better to kind of label these two deposits differently, not, and that would change your intro perhaps a little bit. Okay, so I'll just stop, but we can discuss offline if, yeah.
Should I answer now, or you want to take all the questions?
Yeah, maybe you can answer it right away.
So it's not the case that both are spent before the CM. I mean, I generalized that now a lot because I just gave the intuition, but so the consumers, they're finitely lived. And basically the early consumer works when he's in the CM and then wants to consume in the DM, but he does not want to consume anymore in the next CM, and he's finitely lived. That's the OLG part. And now the late consumer, he works as well when he's young in the CM, but he only wants to consume in the next CM. So he's basically idle in the DM. And that kind of, so it is kind of, there is the payment vehicle in the sense that this is spent in the DM, and then only in the next CM is the late consumer that wants to use the saving vehicle. And then basically from the DM to the CM, the payment vehicle, so the liquid deposits are going to be held by the seller who received them for producing the good. But maybe I misunderstood you, Mohammed, and I'm happy to discuss that afterwards.
Okay, so I'll wait. If there is more time, I'll follow up. Otherwise, on offline. Okay, thank you.
Sure, great.
Okay, we have a few hands. Maybe you can collect a round of questions from starting with Catherine.
Yeah, thank you. So I really like the paper. The question I have is, I may have missed it. So I understood that you assume that the CBDC is introduced and there is a fixed proportion of consumer switching, but I would think that also the design of the CBDC would have an impact. And so whether it's interest bearing and what amount, so how high the interest rate is, and then the substitution, or even if the central bank sets a varying interest rate on the CBDC, this could be even more dynamic. Thanks.
Thank you. Charlie?
Yes. I wanted to think a little bit about what excess reserves means, Story, because it's good and very useful that you've used it on a case with on an era where there are no excess reserves. But when you do have excess reserves, you want to think about the question of what's the definition of an excess reserve. There's going to be some right now with lots of reserves out there. We still wouldn't want to think about all of them as excess, even if they're above the official line, because the banks have some interest in holding them for whatever reason. So I'm wondering, how does the effect of reserve interest rates and the rest translate into your story into whether reserve is excess or not? And if that feedback is taken into case, does that mean that your statement that the case with excess reserves is extremely simple, does that become less simple once you've got that feedback in there?
Thank you. Russell?
Yeah, I will be quick. It is very very beautiful, simple model and super elegant. I like the insight. So the insight it seems to be very, very realistic in the sense that if they are sitting on a lot of excess reserve, it will be like a buffer to absorb any negative consequence from CBDC in the deposit market. So I guess the result, the insight should be applied to more general environment. I saw David Webberpool ask a question, okay, how it depends on the market structure in the Q&A. So I think maybe we can handle it, but it's a very relevant question. I'm just wondering, like what Charlie mentioned. So in a system now, we have floor system, a lot of reserve is sitting around. It seems to be that the central bank can also cancel out any negative effect of CBDC by running a lot of reserve in the system. But go back to your original insight. If the bank they are holding a lot of reserve can cancel the effect of CBDC. And in the end, so this kind of CBDC have to be, this kind of reserve have to be held by someone in the system, right, at the bank. So how is this general equilibrium effect in your model? Just wondering. Thank you.
Okay, thank you all the panelists. Maybe Remo, you can first respond to these questions, and then we have a few questions in the Q&A. If we have time, we can get to those questions.
Yes, okay. So first, to Catherine's question, so thanks a lot to all the questions. First, to Catherine's question with respect to the design and whether it's interest-bearing or not. Yeah, what I do in the model is I think of the case where it is interest-bearing, and then, yeah, what we see is because we have these heterogeneous preferences that also depend on the interest rate differential, what's basically happening is if we increase the interest rate on the CBDC, then people will start to switch to the central bank money. And that's basically a channel that I analyze in the paper as well that I haven't showed you yet. With respect to the excess reserves, what I have in the model, so basically there's different ways how to model it, right? In some papers, what they assume is reserves are basically exogenous and basically that's set by the central bank. Here, it's rather kind of, if you think about a deposit facility of the central bank where you can go and you can deposit. So what basically happens, that's also related to Russell's question, how are reserves affected or how are they channeled? What happened is a consumer or whatever, let's just call it any agent, would go to the bank and say to the bank, okay, and I want to withdraw deposits from you. So what the central bank does, it reduces the reserves and it just generates new cash, right? It kind of gives the cash to the bank and the bank hands the cash to the CBDC to the agent. So that's kind of how reserves will be channeled out of the system if there is a withdrawal of deposits. And with respect to rates, I also show in the appendix how the interest rates on reserves affect the whole story. It's now a bit hard to summarize that in a sentence, but I also look at that. And what I can say, you're right that it's a bit hard to say that there is just the fixed requirement and then everything above is excess reserves. That's totally fair. Here, I guess it's just simplified. So basically all the reserves are the same. They all pay the same interest rate. And that's definitely simplified from reality. Should I go to the Q&A in the chat or?
I think Todd has his hand raised, maybe.
Okay.
Yeah, I just wanted to follow up on this excess reserves discussion. I understood what you just described about the consumer withdraws, the bank loses deposits and it loses reserves. And I think Charlie's point was that affects the bank's liquidity coverage ratio, for example, and maybe some other things like resolution planning. And so if you think about that reserves are not just meeting requirements, they're not just meeting traditional reserve requirements, they're meeting new regulations, that's no longer so neutral that's going to tend to influence the bank's actions. And so then, I interpreted Charlie as asking, should we think about your requirement as traditional reserve requirement or as also including these new things, in which case maybe it's a little trickier to calibrate, but it might be interesting to think along those lines.
I once had a quick discussion about, oh, sorry.
That was a better interpretation, thank you.
Okay. No, okay, sorry, then I misunderstood it. Sorry, Charlie, and thanks, Todd, for clarifying. I once had a quick discussion about that with someone else, I remember, but at the moment, I have to admit that I rather think about classical minimum reserve requirements. I know that in the US, they also put it to 0%, but also if they put it to 0%, you could kind of argue that it's still relevant because it basically just means whether the banks do hold an optimal loan amount or not. But so currently, I rather think about classical minimum reserve requirement constraints, but it's totally fair point that I might want to think a bit more about these other newer liquidity requirements that we have and about them in the model.
Okay, and then first want to bring you to the attention in the chat box that Scott has shared some link to data on US holdings of $100 bills. And then in the chat box, in the Q&A, David Rappaport has raised question about both on the liability side and the asset side of the balance sheet of banks. First, I think he asked on the liability side, do banks finance itself only with deposit, but why not also with equity and other short-term wholesale funding? And then on the SSI, he asked about what is the role of imperfect competition in the loan market? If you can, spend maybe 1 minute or so to quickly respond to it.
I can answer that quickly. So with respect to the first question, they can only finance themselves with deposits. So basically, I kept the model simple. I could add equity and short-term wholesale funding sources as well. So I haven't done that. If people find it interesting, I could do that as well. So far, I kind of wanted to, bring more depth with respect to the two types of deposits, and that's why I abstracted from the other parts to keep it simple, basically. But I could add that in appendix, etc. as well. What's the role of imperfect competition on the loan market? Well, I quickly mentioned that. So the point is that I wanted to introduce some imperfect competition. The point is, because I have these two types of deposits, and I wanted to solve the model analytically as well, it kind of became hard to get the results analytically when I introduced imperfect competition in the deposit market. So that's why for tractability, I decided to focus on the imperfect competition on the loan market, because then I still have imperfect competition. I still have these effects that banks can adjust interest rates, but I still could solve a lot analytically. I think the effects would actually be qualitatively very similar. Quantitatively, if I have perfect competition in both, then it might change a bit the numerical results.
Thank you very much, Remo, for the answer and also your presentation. Now I think we have a few minutes for a short break before we go to the next paper at 10:45. So let's have a few minutes short break then. Break before we go to the next paper.
Remo, I think it is a very. Are you here? So
let's have a few minutes short break.
Can you hear me?
Yes, I hear you.
Yeah, I think it is a elegant model, so simple but sharp to the point. But I don't know whether I am clear about the intuition. So it seems to me the intuition and the insight as long as banks have excess reserve, it can be used to buffer any negative consequence from the deposit outflow triggered by the CBDC, right? So and the insight seem apply to a more general environment in general, right? So because you have some extra buffer, so that the bank can tap. So I think and people might. And then the next question, whether it's buffer, it's really a buffer, then it may be, it can connect to, maybe some of the reserve is not really a buffer because maybe they have to satisfy some Basel III requirement, like talk mentioned, maybe the SCR, the LCR, the liquidity coverage ratio, something like that. Then maybe it is a good way to say, okay, even if we account for some of it, so as the insight is still there, maybe. So it just maybe some of the reserve is not really a buffer, but maybe part of it is just for satisfying the requirement. Maybe I think that the insight is applied more generally. Also with the competition in the loan market as well. Whether it's more have a competition in the deposit market, as long as you still have some buffer on excess reserve, so it's.
That goes. Yeah, sorry.
Yeah.
I think that goes back to the point that some of the first might be held for other reasons, right?
Also,
I agree with that. Maybe I need to think more about it. Maybe one could generalize it in a way that, if you think more abstract about minimum surface bank constraints, and some fraction of deposits needs to be somehow fixed, and you can't use it for something else. More about it. Maybe one could generalize it in a way that, I hear myself. But I agree with that. That make it a bit clearer. That there are these other, I could also introduce other constraints as well. Then again, generalize it in a way that, I don't know whether it helps in the baseline model. But I agree with that.
So Sam, maybe we should let's try whether you can share screen a little bit because we might be going to start soon.
All right, so let me share my screen.
But I agree with that.
So Sam, maybe we should let's try whether you can share screen a little bit because we might be going to.
Are you guys hearing an echo? Like not so much an echo, but the same thing repeated a few seconds later?
Yeah, I think someone has the YouTube video open in the background. I think that's why, but I'm not sure. But I also hear an echo.
I see. Not so much an echo, but the same thing repeated a few seconds later.
Let's get started. So our next presenter will be Sam. So from Yale. So Sam, you will have 25 minutes, and then we have 10-minute Q&A. It's all yours.
All right, so you guys hear me well? All right, so I want to first thank the organizers, Jonathan, Russell, and Todd, for inviting me to present my work here. So my name is Sang, and I'm a job market candidate from Yale Economics. And before I go on, I want to make a quick disclaimer, before I talk about my paper, that this is not really my quote-unquote job market paper per se. So I'm very proud of this paper, or the work that I've done here that I'm about to share with you today. But I'm working on other projects, and I'm working on other projects in digital currency space as well. But I just wanted to ask you to keep an eye out for my job market paper that's going to be posted on my website next week, which unfortunately is not related to the digital currency or the crypto space, but I promise it's going to be equally interesting, if not more. So now that we got that out of the way, let me just begin my talk. So the motivation for this work comes from the fact that there have been many instances of distress in the cryptocurrency market, such as the severe crash in May of 2021 due to the Chinese government's crackdowns on the crypto market, or many other instances of runs on stablecoins that we saw a few months ago when investors ran on Terra and the market capitalization of more than $18 billion crashed down to zero in a matter of days. So this paper is more focused on studying the financial stability issues associated with stablecoins, so the second incident. So the top two stablecoins combined have market capitalization over $112 billion as of a few days ago. And not only that, their growth has been really fast, as their market capitalization as of January of 2021, so just a bit more than a year ago, was only $25 billion. So given the significance of the stablecoin market right now, the research question that I ask in this paper is twofold. First, I ask if the cryptocurrency market is connected to the financial market, as the title suggests, and if distress in the cryptocurrency market can potentially spill over to the financial market. Second, if they are, through what channel are they connected? And I'm going to argue that yes, they are connected, and distress in the cryptocurrency market can potentially spill over to the financial market through what I'm going to call reserve-backed stablecoins. So in the interest of time, instead of just going through the entire literature review, I wanted to mention this one contemporaneous paper by Bartholomew, Garden, and Nguyen to ask a similar research question as mine, but my contribution is to take advantage of the structure of the stablecoin market for identifying the causal effect, as I'll show you later in this presentation. So before I go on to the main analysis, I just want to give you a kind of a really quick high-level overview of the cryptocurrency market and introduce some key terminologies that I'm going to use throughout this presentation. So cryptocurrency was introduced as an alternative form of money that could, quote unquote, decentralize finance away from the central governmental control. And it gained momentum, especially after the global financial crisis, when the government devalued government issued money by printing and disseminating an enormous amount of it through relief programs like quantitative easing. However, cryptocurrency that are not backed by other assets, or what I'm going to call in this paper, fiat cryptocurrencies, like Bitcoin and Ether, are exposed to significant price volatility, which makes it an inconvenient transactional medium. So stablecoin can emerge to remedy this situation. So Tether was established, I think, in 2014. So stable coins refers to digital currency that maintains its price stability by pegging themselves to a specific fiat currency, such as the US dollar. So I think many of these stable coins peg themselves to the US dollars. And they act as kind of a safe asset in the cryptocurrency market, or kind of a gateway to a fiat cryptocurrency market, as approximately 3/4 of trading on cryptocurrency platforms occur between a stable coin and other cryptocurrency. And this is from like a chairman of the SEC a few months ago. So from a high level, there are two types of stable coins based on their pegging mechanism. First is the reserve-backed stable coins that keep a reserve of fiat currency denominated assets to maintain their price stability. So the example include the Tether and USD coin, which are kind of the major stable coins in the market right now. The second type are algorithmic stable coin. And for this presentation, at least, I'm going to call stable coins that are not backed by a fiat currency denominated asset algorithmic. So in particular, they're either backed by other cryptocurrency like DAI, or they're doing some open market operation type algorithm like Terra to maintain their peg to the US dollar. Okay, so this figure is taken from a paper by Liao and Carmichael, and we can see that reserve-backed stable coins, in particular, Tether and USD coin, are dominant in the markets. So if you see here, like I think Binance USD is also reserve-backed. So like the reserve-backed stable coins are like taking out more than 80% of the market capitalization. And this here is showing you the left-hand side, or the asset side of the Tether's balance sheet as of the September of 2021, which is taken straight from their assurance report that was supposedly audited by an independent auditor. So looking at this balance sheet, we can see how reserve-backed stablecoins are pegging their stablecoins to the US dollar. Stablecoin issuances were effectively collateralized by this supposedly safe and liquid money market instrument. We can also observe that a significant proportion of Tether's balance sheet was specifically made up of commercial paper, and this fact will be used put to use for my main analysis of this paper. Okay, but before doing that, let's also look at how algorithmic stable coins are collateralized. Remember, I'm going to call every stable coin that are not backed by fiat currency denominated asset algorithmic stable coin in this paper. So we can see that, so I'm looking at the instance of DAI, you can see that DAI is first over collateralized by other cryptocurrency, and they're collateralized mainly by USD coin, which is another dominant, kind of the second largest reserve-backed stable coins in the market. So I'm going to utilize the structure of the stablecoin market that I showed you and introduced you until now to identify the causal effect of movement in the stablecoin in the cryptocurrency market on the financial market. So I showed you that I'm going to categorize the stablecoin market into two: the reserve-backed stablecoins and algorithmic stablecoin. And I showed that at least until the third quarter of 2021, commercial paper took up a significant portion of reserve-backed stablecoin issuers' balance sheets, while other cryptocurrencies like USD coin took up a significant portion of algorithmic stablecoin issuers' balance sheets. This means the issuance of reserve-backed stablecoins directly affects the commercial paper market, while algorithmic stablecoins affect the commercial paper market only through their effect on their reserve-backed stablecoin. Therefore, I can use the issuance of algorithmic stablecoin as an instrument for the issuance of reserve-backed stablecoin to investigate what the effect of reserve-backed stablecoins issuances is on the issuance quantity and yield of commercial paper. As we saw that treasuries also made up a large portion of Tether's balance sheet, I also study what the effect of stablecoin issuance was on the treasury yield curve. Okay. So I'm going to argue that the issuance of algorithmic stablecoins satisfy the identification assumptions needed for it to work as an instrument for the issuance of reserve-backed stablecoin. First, I show that algorithmic stablecoins are backed by other cryptocurrency, including the USD coin, which is a reserve-backed stablecoin. Furthermore, it's been shown in the literature that stablecoin investors don't really differentiate among different stablecoins when they're making their investment decisions. So when they're equally likely to hold DAI as they are likely to hold USD coin, for example, and Tether. So these facts make it so that algorithmic stablecoin issuances satisfy the relevance assumption. Furthermore, I argue that algorithmic stablecoin issuance also satisfies the exclusion restriction, as the issuance of algorithmic stablecoins do not require the issuer to claim dollar-denominated asset as reserve, which means the effect of algorithmic stablecoin issuance on the commercial paper market works only through its effect on the reserve-backed stablecoin issuance. So given that these two assumptions are satisfied, hopefully, I'm going to estimate this two-stage least square model as follows. I'm going to see what the effect of the daily issuance of Tether and USD coin is on the following day's issuance quantity and yields of commercial paper in the US, as well as the following day's treasury yield curve by instrumenting Tether and USD coin issuance quantity with DAI issuance quantity. So in the first stage, I'm going to regress the combined Tether and USD coin issuance on the DAI issuance from the previous day and use the predicted value from the first stage to see what the effect on the dependent variables are, which are log of commercial paper issuance, commercial paper yield, and the treasury yield. Okay. So the result of this estimation is shown in this figure here. I show that a 1 standard deviation increase in the issuance of Tether and USD coin, which corresponds to about $330 million, results in 11% increase in commercial paper issuance quantity the following day, and 18 basis point decrease in the commercial paper yield. So this shows that the issuance of reserve-backed stablecoins created an excess demand for stable commercial paper, which led to an increase in its issuance quantity and increase in its prices. I also show that an increase in stablecoin issuance or a reserve-backed stablecoin issuance led to a 15 basis point decrease in treasury yield, which means it also kind of, I don't have the quantity data, so it's kind of hard to kind of identify the demand effect, but it kind of provides a suggestive evidence that there's a higher demand for treasuries due to the commercial paper stablecoin issuance as well. So now I estimate the same model across commercial paper, different commercial paper maturities. So I'm going to show you that the estimated coefficients with commercial paper issuance is a dependent variable with lines above and below, again, as the estimate showing you the 95% confidence interval. We can see that the positive effect of stablecoin issuance on the commercial paper issuance is primarily driven by an increase in the issuance of the commercial paper with the shortest maturity of 9 days or less. For a commercial paper with maturity of 10 days or more, the estimated coefficients are statistically insignificant and close to 0. So this shows that kind of stablecoin issuer are really cognizant of cognizant of the need to manage the liquidity of their reserves and thus affect the very short-term commercial paper market. So now the result I've shown you until now includes samples only until the third quarter of 2021. And why did I limit my sample? This is because starting around third quarter of 2021, both Tether and USD coins started to move away from holding commercial paper as a reserve. All last year, there were like rumors and stories about how these reserve-backed stablecoin issuers are holding toxic commercial paper from companies that were about to go bankrupt in a foreign country, for example. So this kind of was an effort to gain credibility among investors. So here, this is Tether's announcement from a couple of weeks ago. Tether officially, I think the date is October 13, 2022. Tether officially announced that they no longer hold any commercial paper. And we can see also in this news article here that they have been working on reducing their holding of commercial paper for a while, since third and fourth quarter of 2021. And this shift in Tether's asset allocation strategy can really be seen when we compare their balance sheet in the third quarter of 2021 and in the fourth quarter of 2021. In the third quarter, we can see that the commercial paper and CD took up about 44% of the reserves, while the Treasury took up about 28%. However, in the bottom panel, in the fourth quarter, we can see that this kind of flipped. Commercial paper and CD's proportion was reduced to 31%, while the Treasury's proportion was increased to 44%. So looking at the strategy shift, it's natural to ask what its effect was on the commercial paper market. And to do this, I'm going to estimate this model where I include an interaction term with the dummy variable that equals 1 if the observation is from the fourth quarter, after the fourth quarter of 2021. So this table shows that the estimated coefficients for beta 1 on the interaction term are negative, which means after the fourth quarter of 2021, an increase in the issuance of reserve-backed stablecoin did not affect the issuance of commercial paper, or actually had a negative effect on the issuance quantity of commercial paper. Estimating the same model, but with the commercial paper yield as a dependent variable, we can see the same thing. The estimated beta 1 are either statistically insignificant as in the asset-backed commercial paper case, or even positive, albeit only 90% of confidence interval, positive for various different types of commercial paper. So these results provide kind of a suggestive evidence that after fourth quarter of 2021, stablecoin issuers were kind of indeed unloading commercial paper from their reserves. So now you might be asking, sure, this kind of sounds cool and good, but why didn't we see any of these effects last May when people ran on Terra? And more than $18 billion worth of market capitalization got wiped out in a matter of a couple of days. So I'm going to argue that this was because Terra was also an algorithmic stablecoin that did not hold any dollar-denominated asset. And to show this, I'm going to see what the effect of DAI issuance was on the commercial paper market, instrumenting DAI issuance with Terra issuance. And since Terra has come into significance very recently, the time series is a lot shorter, and the first stage F statistic is a bit too low. But considering all this, we can see that the DAI had a muted effect on the commercial paper market. So we can extrapolate from this result that Terra meltdown last May did not affect the financial market that much, because it was an algorithmic stablecoin that did not directly hold a reserve of commercial paper or treasury on their balance sheet to maintain their peg to the US dollar. Okay. Finally, I'm going to show you what the effect of cryptocurrency market is, fiat cryptocurrency market is on the commercial paper market. So fiat cryptocurrencies are those that are not pegged to a specific currency like Bitcoin or Ether, right? So I show that a 1 standard deviation increase in the market capitalization change of the top 3 fiat cryptocurrency, which is Bitcoin, Ether, and Binance Coin, resulted in a 11.9% decrease in commercial paper issuance quantity, 21 basis point increase in the commercial paper yield, and 18 basis point increase in the treasury yield. So I interpreted this result to mean that an increase in market capitalization change, which signifies a favorable fiat cryptocurrency market, makes investors exchange stable coins for fiat cryptocurrency in order to increase their exposure to the fiat cryptocurrency market when the market is favorable. This decreases the demand for stable coins, which in turn decreases the demand for money-like assets like commercial paper and treasuries. Okay. So I'm going to use the last few minutes that I have to discuss kind of the policy implications of this paper. So the financial crisis is an event when lenders, there's kind of a view that financial crisis is an event when lenders run on privately produced money like safe assets because it loses its role as money, like we saw when investors ran on repo during the global financial crisis. And there is an argument in the literature that argues that reserve-backed stablecoins can be viewed as the newest form of private money. So if you take this view, stablecoins are the newest form of money like safe asset or private money, such as demand deposit or repo, and stablecoin issuers are the newest form of banks that hold very liquid, safe and liquid form of assets on their balance sheets. So from this perspective, there's a potential for a run on stablecoins. So there's a long-running theory in the safe asset literature that when investors, when investors get anxious, when investors get anxious about the collateral that's backing the safe asset and gain an incentive to conduct costly information production on the collateral, the asset turns information sensitive and loses the role of money. So this is what we saw when, for example, investors ran on repo during the global financial crisis, because investors lost confidence on many of the MBSs that were backing the repo contract. So in order for reserve-backed stablecoins to be information insensitive and function as a valid form of money, it needs to build confidence with the stablecoin holders or investors that their reserves, which is effectively the collateral for the stablecoins, is beyond reproach when it comes to safety and liquidity. So I argue that Tether and USD coins shift away from stable commercial paper to treasuries is an attempt to build this confidence and retain information insensitivity of the stablecoins, because people were questioning and kind of clamoring for like the more specific kind of details about the balance sheet of these reserve-backed stablecoin issuers. Okay, so let me summarize and conclude. I showed you that the cryptocurrency market is connected to the financial market through what I call reserve-backed stablecoins. Stablecoin issuances, increase in stablecoin issuances led to the issuers to buy up the short-term money like safe assets such as commercial paper and the treasury from the market, which exerted an upward pressure on the demand for this kind of safe asset, and it made them increase the issuance of this asset and lower the yields of these assets. I also showed that when the market for the fiat cryptocurrency turned favorable, investors trade stable coins for fiat cryptocurrency, which lowers the demand for stable coins, and we resulted in the opposite direction of the empirical relationships. So finally, we saw that the distress in the reserve-backed stablecoin market can spread to the traditional financial market and ultimately to the real economy through commercial paper and the treasury market. A run on stablecoins means stablecoins holders exchange stablecoins for the US dollar en masse. To honor this exchange request or redemption request, the stablecoin issuers need to sell off their assets, including their commercial paper, which is not really true right now because they don't hold commercial paper right now. But this sell-off will put an extreme upward pressure on the commercial and treasury paper yields and ultimately affect the real economy by shooting up financing costs for every market participant in the commercial paper market and in the treasury market. So that's kind of the channel through which I imagine that the distress in the cryptocurrency market kind of can spill over to the financial and the real economy. So let me conclude my talk here, and I'll welcome any questions from you guys. Thank you so much. Participant in the commercial paper market.
All right, thank you, Sam. Can you stop sharing screen? And we are now, it's very neat identification strategy. So we are now open for Q&A. So if you want to ask question, please raise your hand. We will do for 10 minutes. Okay, maybe Mohammed first. All right.
Okay, thank you. Very interesting presentation. So just one question. Quantitatively, it seems to me that what you're saying is that like one standard deviation, which was you said around $330 million, lower the yield in terms of in the order of like 10 to 20 basis points, that much. So it seems a little bit large to me, but my question is that do you like, have you seen the literature? Do they have comparable numbers in terms of like the literature that look at the kind of the treasury market? And I assume there should be some estimates already. And do you have some kind of benchmark to compare your estimates with them quantitatively?
Yeah, so I think the paper I mentioned in the introduction, that they do something similar to mine, and I think their numbers are a lot smaller than mine for sure. So I was kind of surprised when I first came up with this number that the numbers does seem kind of hard, right? Kind of large, like in terms of like 11% decrease in the quantitative issuance. So there might be something going on in terms of when I'm instrumenting the reserve-backed stablecoins with algorithmic stablecoins, because I showed you that there's kind of this empirical result that there's these kind of stablecoin market capitalization kind of moves in lockstep. So there might be some I guess not endogeneity, but there might be some correlatedness within the market capitalization issuances among stablecoins that makes this estimate a little larger than it sounds. But I think the numbers, quantitatively speaking, quantitatively speaking, I think the only other paper that kind of does a similar thing is the paper that I mentioned in the introduction, and they have smaller numbers as well, but they don't have like IV strategy that I did, so there might be endogeneity going on there too. But yeah, I'll look into it. But in terms of like a quantitative, the magnitude of the number itself, yeah, that's what I have right now. So yeah. The other paper that kind of
Christoph,
is the paper that I mentioned.
Thanks for this really interesting presentation. During your talk, I was wondering about the pecking order from the viewpoint of an issuer. You ask yourself the question whether you sell the more liquid asset first or which asset to sell. And I was kind of wondering if you can say something about that. And I guess that in practice also depends on the financial market condition, which type of asset at which quantity you'd like to sell. Thanks.
Yeah, I mean, I think that really depends on the specific market condition of, for example, commercial. I mean, they don't have commercial papers. I don't want to talk about commercial paper anymore. But market for CDs versus market for treasuries, right? So they're gonna sell off the treasuries. The market is favorable for them. So is that the thing with this kind of reserve-backed stablecoin issuers is that there's been a lot of controversy in terms of like them not being able to. They're kind of arguing that they're being audited. But are they really being audited because they're based on this kind of Cayman Islands, for example, and that there's no way for the authority to kind of really delve into kind of the liquidity or reserve management strategy that they're pursuing. So I don't have a deep insight on like the specific reserve management strategy that they're using, but I think I agree with you, Christoph, that there might be market favorability kind of thing might be going on there. So for sure. For the authority.
So before I move to Jonathan, so there's also some question in Q&A maybe related to what you have just discussed. So maybe I can read right here. So maybe I start from the second one. So maybe a little bit more technical. So there might be some there might be a unit root issue. Unit root means okay, there's stochastic trend in the level of yield. So is there any way you can handle it in your estimation? So that maybe and the second question is how the mechanism for stablecoin issuance are better in the commercial paper issuance. The mechanism you have in mind, maybe related to what you talked to also.
So I guess first for the econometric question, I think I tested all the unit root issues with the commercial paper yields. So the yield changes, I tried yield changes and I think the results are pretty much the same. So what I'm doing like issuance on changes on changes because I care about unit root issues in those kind of when I'm estimating the time series model. So I think you can be sure that there's no really problem with that. So in terms of their second question, what is like?
The second question is what is the mechanism the stablecoin issuer will affecting the commercial paper?
I'm not really sure what you specifically mean by economic mechanism, but what I'm saying is that when they have to issue more stablecoin, they just need to buy up more safe assets from the market. So they want to when they issue $1 more of stablecoin, they have to buy dollar more treasury from the market. So that's how I'm thinking these two markets are connected.
Right. So Jonathan?
What I'm saying is that.
Yep. Thank you, Zhang. I think it's very topical question and very interesting result. And just have two quick questions. One is that, as we know that a DAI is partially, backed by USDC, I think since March 2020.
Right.
So just a suggestion, maybe it would be cleaner if we focus on, the sample before that day, so that we don't capture any indirect effect through USDC. And then another question is, how in terms of interpreting the result at the channel, how can we be sure that it's not, through the effect of a third common factor, such as say policy rate change that may affect both the demand for DAI and the demand for commercial papers?
Okay. I guess for your first question, yeah, limiting it to before March 2020 might be, but I'm sure like people who are engaging in empirical research in this space know that the time series is very limited, right? So every observation matter is very valuable, and especially before like 2020 or 2019, like the data is very noisier because not many market participants were there in the stablecoin market. It's been after the COVID crisis where the noise in the data kind of really subsided because there were a lot more market participants in the market. So yeah, I'll be sure to do a robustness checks for periods before they had the USD coin. And for your second questions, in terms of, for example, like for policy rate changes potentially affecting commercial paper issuance and DAI issuance. Yeah, I mean, there is I guess I have to admit that is a potential endogenous problem, but what I'm trying to do is that they're affecting the effect of policy rate changes on the commercial paper market is much more direct than its effect on, I think, DAI issuance, especially considering that especially considering that DAI is kind of algorithmic stable coin. So yeah, I'll have to admit there is some problem with that, but I'm using the identification strategies to kind of clean up those kind of things as well. So thank you so much for your comment, John. On the commercial paper market,
so Alvin,
direct than its effect, I think DAI issuance.
Yeah, I was wondering, maybe I missed that part, but the issuance is and the investment in commercial paper is probably lumpy, right? So if somebody requests 1,000 new stable coins, then they will not immediately mint new stable coins, or they will not immediately purchase commercial paper for that. So I guess they have their own reserve. So maybe can you tell us a little bit more about the institutional details of
right
how this process works?
So again, like specific institutional details on how they exactly manage their reserve is like very opaque because they really don't want people to know a lot about their reserve management strategy. So like I'm really going down to the basics and seeing kind of, I guess it's more of, I guess, an assumption that they're very active in this in the money market, and in terms of them trying to manage a reserve liquidity, because like when you see kind of the yeah, I think so. That's kind of what I'm kind of, I guess it's more of an assumption that, yeah, they're very active in the money market for sure. Yeah. They're very active in this commercial.
All right. So we are in time 1 minute earlier. So maybe I happy to talk. So we will have the last one.
Yeah. Yeah, I think so. That's kind of what I'm.
Okay, well, thanks Song, and thanks everybody. So our final speaker today is Luciano Somoza from the Swiss Finance Institute and HEC Lausanne. Luciano, the floor is yours.
Do you all see the screen?
Looks good.
Perfect. So thank you. Thank you for being here. Thank you for organizing this event. I'm very happy to be here. I start off with an anecdote. I have a cousin in Milan who's a physiotherapist, has zero interest in anything related with finance whatsoever. And 2 years ago, she had 20K to invest. So she went to her bank and she asked for an investment portfolio, and the financial advisor prepared a portfolio for her. And before signing off, she remembered she had a cousin doing a PhD in finance, so she reached out to me and said, "Do you mind checking it out for me?" I said, "Sure." I opened it, and she had 27.5% of her portfolio invested in cryptocurrencies. She has no financial knowledge whatsoever. That was the financial advisor prepared portfolio indirectly through ETFs, right? But still. And then I realized, okay, maybe even if you don't believe in this thing, you should really pay attention because it's pretty much everywhere. And I highly encourage all of you to go back home and check your relatives' investment portfolios when you go home tonight. So they're everywhere. Of course, even like Fidelity introducing the 401ks, Goldman thinks it's a good store of value. Truth is that the argument is often that, okay, maybe it's a diversification tool. The fundamental value is not obvious. Therefore, there can be an argument since the fundamental value is not obviously correlated with the market, might be diversification tool. And then you have people like the CEO of Man Group saying, okay, there is no inherent worth, but it's good to trade, which is very often a rationale for going into this market. So, of course, the literature, there have been some papers approaching cryptocurrencies. I'll always talk about Bitcoin because that's in my data set, that's 80-90% of the trades, right? Bitcoin say, okay, there might be a fundamental value which is linked with transactions, so some transactional value. You can use it for transacting, and therefore there is some value, and be some theory based on this. This is definitely true. If you look at this paper by Foley, amazing, on estimating how much of cryptocurrency transactions are linked with illegal activities, right? And the answer is not that much. So it's not clear how you can explain price movements in Bitcoin, very extreme over the past few years, using transactional value as a fundamental. Empirically, we know that there are network effects. We know that we know some patterns about it, but we don't know today is why does Bitcoin move together with the market, which is my my key question, what I look at. So this is the correlation between S&P and Bitcoin, and you can see that was roughly uncorrelated until 2020, jumping around 0, and then it jumped up to almost 60%, and it stayed there ever since. This is S&P. If I show you NASDAQ, this goes up to 80-90%. So this begs the question, what drives this crypto-etic correlation? Why has Bitcoin started behaving like a tech stock? Because especially when there are certain periods, it really behaves like Tesla or like GameStop or some kind of tech stock, right? So this is my research question. To give you a overview of the results, my main takeaway is that retail investors are driving this correlation. I explain you how and why. I start off with this toy model to make the argument a bit more formal and gain some insights. I derive some implication and test them in the data. So I'll show you that retail investors trade cryptos and equities at the same time in the same direction. I'll show you that this behavior started in March 2020, really, and that the stocks that these people like, when these people are trading, are the one exhibiting this correlation. So it's not every stock, it's just a specific subset. So again, it's a very nutshell, toy model. I show you this new data set that I'm using. I go with this data set at the micro level, at the investor level, and then I go and look at global markets and show you patterns in the global market consistent with my model. I start with the Kyle model. It's an extension of the Kyle model. So this is a very workhorse model, but maybe not everybody's familiar. So just a couple of slides to be everything on the same level. So the Kyle model is a model of how information enters the stock market, and you have an informed and uninformed and a market maker. You have three types of agents. The informed investor knows the true value of the asset they're trading. The uninformed investor is just trading at random, and the market maker is observing the total order flow. So they see the total order flow, try to understand whether the informed trader is trading or not. And based on the prior the market maker has about the distributions and the fundamental value, it adjusts the price based on the order flow it observes. The equilibrium is defined by the order of the insider trader, which is a function of the fundamental value and some level of aggressiveness, and on the price adjustment by the market maker. That has some prior and then some price impact of the order flow it observes. Now, in this setting, we add a second asset. So we have one asset and we have a second asset with three key hypotheses. So the first hypothesis is that the fundamental values of the two assets are uncorrelated. Now, White might argue on why or how Bitcoin might be correlated with the stock market, but I take the view here that is fundamentally uncorrelated. Now, Bitcoin gives no right to cash flows. It gives no right to real assets. It's not obvious what the fundamental value is. If you argue that it's linked with transactions, say, sure, transaction in legal markets, maybe. But we take the view this is uncorrelated with the fundamental value of the stock market. Second hypothesis is that there are two market makers. So the market is segmented, which is the case today. So today, the main actors on the Bitcoin market making is not the same as on equity markets. This thing is changing a little bit in recent months. It will change probably in the future. But today you have mostly specialized market makers. You have all kind of algorithmic activity. So it's very segmented market. The market infrastructure is still very separated. This hypothesis is key. And I'll change this hypothesis at the end. I'll show you what happens. Because the model seems trivial, the one I'm going to show you, but when you tweak this hypothesis, it changes completely the results. So this is where we are now. The third hypothesis is that then there are uninformed investors trading both asset classes with some kind of pattern, right? There is some correlation. So whenever they are doing something on the market, there is some correlation with what they're doing on the other market. I'm not saying it's positive or negative, they are doing something. So these are the three key hypotheses that bring inside the model. So very quickly, you see the first one translating zero correlation fundamental value. The third one translates into this ROA, which is the correlation between the order flow of the uninformed investor across the two assets. And the second one is the market maker only observes one order flow, so on their own asset, not on the other one. This is the equilibrium, which looks a lot like the Kyle with the two different assets. Now it looks a lot like a Kyle, but then when we take the, we look at the correlation between the prices, right? This is actually dependent on the correlation between order flows. So this depends on ROA, and it has the same sign as ROA. So the first prediction of the model is, since we observe positive correlation between Bitcoin and the stock market, therefore, we have to observe a positive correlation between uninformed traders' order flows. Now, in my setting, uninformed traders are retail investors, and that are trading a few thousand euros. Sorry, francs in this case, because they're in Switzerland, that's your data set. And they have to kind of go in the same direction. The second implication is that there must be something happening in March 2020, right? So this behavior should not exist before March 2020 because there was no correlation before that date. The third one is that this should be this phenomenon should be more important for when the retail investors are active, so when they are actually trading, because there are a lot of uninformed trade, but these people are the one trading on both markets. And the fourth one is that this phenomenon should be more significant for the stocks that they like, so the one they tend to trade. So this is a data set I'm using. It's a Swiss bank, which is called Swissquote. Now, Swissquote is a bit of a special bank in the sense that it's a digital bank, but it's been around for over 20 years. It's been listed on the stock market in Switzerland for over 20 years. And it's also the financial service provider of the post service in Switzerland. So it's very institutional. And they offer both trading account on normal securities and cryptocurrencies. But on cryptocurrencies, not in direct trading, it's not ETF, we're talking about actual wallets. So people can have a wallet with Swissquote, they can transfer token in and out from other platforms, and then they can trade on the bank crypto exchange. So this is a special setting because there are very few banks worldwide with this kind of services, and they were probably the first. They started doing this in 2017. The reason is that Switzerland regulation on cryptocurrency is very lenient compared to other countries. So you can have bank offering this kind of services. And they are the undisputed market leaders on this. The bank is famous for online trading, so people go there to trade. So we observe how much money customers have with Swissquote, but we don't know how much money they have in general, right? So customers tend to have real estate, they tend to have other savings for retirement, and then they have maybe 20, 30,000 francs to actively trade with Swissquote. So we have a random subsample of customers of the bank of 77,000. We have holdings between 2017 and 2020, and then of which, well, these 77,000, 16,000 open cryptocurrency wallets. So we have data before and after the open cryptocurrency wallet. They tend to be more male, they tend to be younger, they tend to trade a lot more than the others, and they tend to have high returns because Bitcoin perform very well, right? So high return and much higher volatility in the portfolio. So it's exactly what you would expect from an anecdotal point of view of what the cryptocurrency investor is. This is just to show you, 0 is when they open a cryptocurrency wallet. And this is number of months before and after. And this is the average number of logins to the platform. And what you see is that it goes from 6 to 7, so once every 3-4 days, to up to 14, so once every 2 days. So they log in much more often to the platform after they open a cryptocurrency wallet. This is just to say there is something significant happening to them. Now, from now on, I'll use, for next two regressions, I'll use a difference in difference, stagger a different setting. Clearly, opening a crypto wallet is not an exogenous event, so I cannot claim causality with it. I'm just showing what happens to them after they open a crypto wallet. The first thing I look at is trading activity, because that's what they usually do with Swissquote. It's the main objective in having an account with Swissquote. So you have fixed effects for investor and time, so stagger diff and diff, and then you have this variable, which is crypto user. The dependent variable is stock turnover, meaning what? Is the percentage of their equity position they traded in a given month. So if I have on average 10,000 francs of equities and I insert order for 5,000 francs this month, this measure is going to be 50%. Okay, so this measure can also be 500% if I trade a lot. So it's all the orders divided by average holding of equities. What we see is that after they open a cryptocurrency wallet, they reduce their trading activities in equities by 7%. So they trade less equities as soon as they open a crypto wallet. So it seems like they are moving their attention towards this new asset. And we also observed that the trading in the two asset classes is correlated positively. So they trade less less equities on average, but when they do so, they tend to do it at the same time as cryptos. Now, what does this mean? To me, this is a strong indication. I'm going to look into it. An hypothesis is that they think of the two asset classes as the same thing, kind of the same thing, right? Because they're substituting attention from one to the other, and then they tend to trade them at the same time. So one might think that the line of reasoning behind is that they think they're kind of the same asset. So is there substitution? Well, to see whether this is a story about attention, I look at performance, because we know that they tend to do horribly. We know they have a lot of biases. They tend to lose money on average compared to the market. And there's a long literature of all the biases of retail investors. So we look and say, okay, if they're paying less attention to equities, they should be doing better on equities, which is indeed what we find. The dependent variable here is the Sharpe ratio of the equity portfolio, and it increases after they open a cryptocurrency wallet, indicating strongly that they pay less attention to it because they tend to time the market wrongly. They tend to do bad decisions, as we know from the literature. So they do better. And this goes in the direction of saying, okay, they are substituting equities with cryptos. And the trading in the two asset classes is correlated, as I just showed you. They tend to trade them both at the same time, meaning that our assumption in the model is validated in the data. But the model makes a very strong prediction, says, okay, but this correlation needs to be positive. It's not enough to have a correlation, it needs to be positive. Now, there can be two stories here, right? Because it's not obvious. On one side, you can say, okay, cryptocurrencies are going well. I sell some crypto and I buy some equities. I rebalance a bit. There are wealth effects here, right? And then we should observe a negative correlation in the order flows. Or you can say, okay, maybe on the other hand, I'm very optimistic. I buy both assets. Or I'm very pessimistic. I sell both assets. This is possible because they tend to have very large cash positions. So they tend to have up to 50–60% of their overall holding with the bank in cash during periods where they're pessimistic. And this can go down to 10% when they're very optimistic. So a kind of a sentiment story. I run the following regression where I have as a dependent variable the net order flow in equities. So buy order minus sell order. And I have, for the crypto, I have buy order, I have sell order, and I have the net. Regardless of specification, regardless of fixed effect, this is always positive and highly significant, which is consistent with prediction one. So they tend to trade both asset classes at the same time and in the same direction. This is the key finding of this first empirical part. Now, from this, as we said, is not enough. This needs to start in March 2020, as I show you before in the graph. And as a matter of fact, it does. So when we look at what happened here is that it goes from roughly 0. This is the correlation between net flows in cryptos and in equities on the Swissquote platform. So this correlation is basically 0. And then it jumps through the roof in March 2020. This is weighted by trading flows, because here trading flows on crypto was close to 0. So it was, it was a bit noisy. Still very evident effect, but a bit noisy. Here you clearly see, because when you waited by trade, you clearly see that all the effects comes really in March 2020. So what happens in March 2020? This is consistent with prediction 2. This is our interpretation. We say, okay, these people had a liquidity and attention shock. Now there is some literature showing that in the US, stimulus checks were used to invest in equities and in cryptocurrencies, that they had an impact on stock prices. There's a paper by Greenwood and Laritz and Wurger, and also that a lot of people use this to buy Bitcoin. This paper by Divakaruni that shows that the number of orders on the blockchain for 1,200, which was the amount of the stimulus check, spiked when on the dates people received stimulus checks. So a lot of people took the stimulus checks and invested in Bitcoin. Now, Switzerland did not have stimulus checks, but this still was a significant liquidity shock because people were home, they were receiving the full salary, and they were not spending anything. And Switzerland is very expensive. It's very, very expensive. So myself, all of a sudden, I had a lot more money on my hands. And as a matter of fact, I invested it with Swissquote at the time. So this was a very common phenomenon. Also, keep in mind that at the time, Bitcoin was kind of up and coming. So a lot of people kind of knew about it, but they were not really familiar with it. It's like, I don't have money for a car, but if I get a very good job on the job market, I might buy a car, meaning that I'm going to look into cars and going to spend my money to buy a car. It's kind of the same thing. All of a sudden, they had time and liquidity, and they invested in this new asset class. Keep in mind that the spike in Bitcoin price was not in March 2020. It was later on at the end of the year. So here, the Bitcoin is still around 9,000, 10,000. So the spike in price is subsequent. So now we cannot be sure that the rest of the world works like Swiss investors, right? So we have a sample that is localized in Switzerland. They tend to invest in US stocks. The overwhelming majority of the trades are on US stocks. So what do? We look at global markets, and we take the 3,000 most traded US stocks and we rank them by the relative trade by Swissquote crypto investors. So we just take the trading volume by Swissquote investor, divide it by trading volume on the stock, and rank the stock. So on the 5th quintile, you have the stocks that are relatively more traded by crypto investors. And on the 1st quintile, you have stocks that are relatively less traded by crypto investors. Keep in mind that crypto investors tend to trade on few stocks. So the 5th quintile is where most of the trading is concentrated. Now, this is a summary stats of what these quintiles look like. So from Q1 to Q5, clearly is more tech, is larger stocks, and it's growth stocks. Surprisingly, also is healthcare stocks. And this is, well, it's not surprising. The fact is that retail investors tend to be attention-driven. So COVID, people heard about healthcare and they invested in it. So it's very consistent. And we run 5 regressions, so 1 on each subsample. The dependent variable is the correlation between a given stock and Bitcoin. And the independent variable, you have a few controls and the global volume on the Bitcoin market. What we find is that volume on the Bitcoin market is positively associated with correlation between Bitcoin and stocks. And this effect is much stronger for stocks which are preferred by retail investors against those who are not preferred by retail investors. Now, we are still looking at global Bitcoin volumes. Here, we're just looking at global markets, so up there. But there is a lot of volume on Bitcoin, which is not from retail investors. So we add a second variable. We had trading on Swissquote as a proxy for retail trading on Bitcoin. Clearly, this measure is correlated with global volume, but it's not multicollinear because there are way more things going on the global market. This is the result. So as you can see, the effect on Bitcoin kind of fades away, so it goes to 0, and then it becomes even negative on the global market. But then the retail measure picks up all of the effects, and it becomes much more clean and much more linear across quintiles. So this is just to help you visualize it. This is the from 1st quintile to the 5th quintile. This is the global Bitcoin volume. This is the retail Bitcoin volume. And this is very consistent with the prediction of the model 3 and 4. So this correlation that we observe between stocks and crypto, it's concentrated in periods where when retail investors are active and on the stocks they like, which is our prediction 3 and 4. So to summarize this part, cryptocurrency capture the tension, as we said, right? So they kind of shift attention away from equities. but they tend to trade both asset classes at the same time in the same direction. And this behavior really started in March 2020. Now, when you look at global markets, what we find is that the stocks that retail investors who trade cryptocurrency like are the ones who are the most correlated with Bitcoin, and are the ones who are the most correlated with Bitcoin when these people are trading. So this effect is very localized. We look at the index and say, okay, S&P is correlated with crypto, but it's not really the case. It's just certain stocks are, and are these specific stocks. Now, as I mentioned before, this relies on the hypothesis of market segmentation in our model, right? In our model, if we change this hypothesis, I'm not going to go through everything again, just show you the result, which is the correlation becomes negative. Why? Because the market maker observes both order flows and is able to tell apart, is more information, is able to tell apart the informed from uninformed, and is somehow trading against the uninformed. And by doing this, the correlation becomes negative. So my point is, this is an effect that we observe today, given the market structure, but in our model, it's not necessarily the case tomorrow, whether if there's going to be market integration. So the takeaways, 3 takeaways. The first one, retail investors drive the crypto equity correlation. So if people think of Bitcoin as a tech stock, it will behave as such because of the market structure and because of what I show you so far, right? And I think that we have some compelling evidence that people do think of this asset as a tech stock because that's what they're substituting for in their trading activity. So now, clearly, Bitcoin is a bad diversification tool because it's highly correlated. But during market turmoil, one should expect, one should expect this to be even higher, the correlation during market turmoil. So when retail investors are very active. If you look at the Bitcoin price over the past few months, over the past year, actually, you see it was highly correlated in the spring, where retail investors were panicking and selling off. And and the correlation kind of flattened out during the summer until today because retail activity is extremely low. Now, unfortunately, all the data I showed you is 2017 to 2020 because we started a paper before Swissquote finished their annual report for 2021. So we had access to data to 2021 and 2022. We saw all the results hold, and hopefully in a few months from now, I'll be able to update the paper with the new data, but still all the results I showed you is not just 2020, is up to today. And the final point is that for policymakers, and I know there are a few in the audience, this is a possible transmission channel. So if you observe a meltdown on crypto, you should expect effects on whatever assets retail investors are holding, because they panic, they sell all the portfolio. So this is something that I think is important to consider for policy implications. So thank you. I'm John Market this year. I've worked on digital money, not just cryptos, but a lot of central bank digital currencies. You can find my papers on my website. And thank you for listening. Any question, any email, any comment, really, I'm more than happy. And if you don't manage to ask questions now, please send me an email.
Okay, thanks very much, Luciano. Questions from the audience? Yeah. So Russell, go ahead.
Yeah, it is amazing data. So it is one. I have 2 questions. One may be clarifying question, another may be about the data. So so the story is a Kyle market making story. So but one thing might be special about crypto is there's no centralized market maker if you trade on chain. So so I'm wondering, so if people in your data, if they choose in your Swiss bank, so is there any premium they pay for the crypto compared to other decentralized market? So that might be I don't know whether it's evident or not to the Kyle story, right? If there's a premium, there may be a supportive to the Kyle story. So the other question is about the data. So so I guess we observe the individual trade level data. So every transaction, every return, every rebalancing, we can see. So I'm just wondering whether there is a timing of the trading. So maybe the timing they open a crypto account is endogenous as well. Maybe my portfolio crashed, so that's why I'm open a crypto account and move into the crypto space. So then in this case, it might change a little bit the regression you are running because of the timing is endogenous. You choose to become a crypto guy. Thank you.
Should I answer directly or take all questions and go?
Yeah, let's try answering directly.
Okay, yeah. So the market making, it's true. It's a very complicated market making on the crypto market. Now, for the Kyle, whether there is one market maker or a continuum of small risk neutral investors, it's equivalent. So this, I think, kind of saves the day on the crypto side. Although there are, it's developing for our setting. Swissquote is not doing market making on equities, right? There's giving the trade to other platforms. They are doing some market making on cryptos, although we're not fully sure on the details on that side. So they are not the kind of unified market maker that I have in model, right? Swissquote clearly isn't. But again, I think that there is some good insight because there is this additional information from the two flows. And I don't think it's impossible in the future to think, okay, I observe a certain flow on Tesla, but I also observe a flow on Bitcoin, right? So maybe this flow is uninformed. I don't need to adjust my price as much. This is the first one. On timing on trading.
Luciano, so one clarify. So maybe a related point is also, do we see the price that people pay for the crypto on the exchange are very different from when they trade in some decentralized exchange? So if there's some premium, that might be signaling something about the information storage.
They are trading on they're trading with Swissquote on Swissquote platform, right? So we don't see what they would pay on other platforms. So in our data set, they can only trade with the bank, their cryptos, right? And and pricing, they say they're the best in Switzerland. I don't know, but they cannot use these tokens for the centralized applications. That for sure in this setting, right? They, in order to use it for centralized application, need to take the tokens, take them out of the platform, and then maybe go on some other platform they can do it. We cannot see it, unfortunately, in this setting.
Sorry, I had trouble unmuting. Remo.
Yeah, thanks for the great presentation. So I think the story seems very legitimate to me. I remember another presentation where they kind of showed that with the introduction of the futures market, Chicago futures, Bitcoin futures, that this kind of was a leading indicator for, was kind of the lead for the price. That kind of troubles me a bit with this story. Now, I don't know whether you know something about that and you have something to say about that, whether it's kind of disappeared again over time, because I don't remember the paper properly, but if kind of the Chicago futures Bitcoin market should be kind of a leading indicator, that kind of would be a bit contradictory to your story, right? Or maybe, yeah.
I'm not 100% sure I got the comment, but I mean, I think that here, people think about Bitcoin and think about much more sophisticated actors usually, right? So you have, the future, et cetera, et cetera, et cetera. Here, we're really talking about the average Joe in Switzerland who has no idea about anything, who doesn't even know probably the fees he's paying for trading on this market, right? And what we see is that all this correlation is really concentrated on this kind of investors. Then, of course, I mean, you have all of the effect that might affect this thing in the future. But I think that at least so far the evidence is quite compelling that this subset of investor is really driving this correlation. I think there is a
Katrin.
Katrin, yeah.
Yeah. So I would like to come back to your policy conclusions. So
yes.
Because you're saying, and I see how this comes up. So the retail investors are driving the correlation, and you say therefore it's policy relevant. So typically, central banks are interested about what banks are doing because they are their customers if they come into problems and financial stability is threatened. So with retail investors, and at the beginning you said that these are guys that set away some 2,000 francs and are trading on these 2,000 francs. So I see that they are driving a correlation, but they wouldn't threaten the financial system in my view. So. Of course, they drive a correlation between crypto and these tech stocks, but as long as banks are not engaged in crypto, so I don't really see why a central bank should be worried about this correlation.
I think it's a fair point. My mention of policymaker is that I got policymaker reaching out and asking, please, can we use your data because it's very interesting and we're looking at impact on financial markets from these people. So I agree that it's not maybe central in the sense, right? If Tesla collapses because crypto collapses, maybe it's not particularly relevant. But I think that the overall mechanism and saying, okay, right now we understand there is this further channel here, at least from conversation from people from Bank of England, for instance, they were very interested in this and might want to look more into this kind of mechanism. I'm not arguing that this result can automatically lead some kind of regulation or anything peculiar, but I think it's kind of helps the overall understanding of how these two markets are linked, because now there's a lot of focus on stable coins, rightly so, right? Because this transmission channel there is self-evident. They have all this backing in real markets. Here I'm saying, okay, there is a further channel here, which is if you have some kind of meltdown on crypto, then you should expect at least probably some kind of heavy selling activity on certain.
But have you really established causality, or are you looking at correlations?
I'm trying to establish causality in a follow-up paper that I'll work on right after major market. That's in my pipeline right now. I'm trying to establish causality of, I have some shock here, I want to see what happens there with kind of causal. That's part of my research agenda in the short term.
So maybe something related to the trading dynamic we talked before, maybe related to cash portal. Maybe one mechanism, it maybe the fire sale mechanism, maybe the household they are crash in the crypto space, and then it will be will trigger the household will also selling or dumping the stuff in the traditional sector. So if we can see this kind of trading dynamic, maybe the one space in crypto can spill over to other stocks. So that might be one mechanism that you could see. Yeah.
I think this mechanism.
I see the mechanics. So what I'm doubting is the size of the crypto market is causally driving a decline in the tech stocks. That's my point.
I think that the impact of retail investors used to be very neglectable, which is true. But over the past 3-4 years, if you look at volumes by retailers, went from 55% to 20-30%. So, and especially when they focus on certain stocks, they can have a very heavy impact. So because right now, if I say, okay, retailers have an impact, people say, not convinced. But if I tell you GameStop, do you think they had an impact on GameStop specifically? Most likely, yes, right? So in certain periods, when they have focalized activity, they can really have an impact. And especially when you have this kind of huge liquidity impact like we had in COVID, then you should expect them to have an impact. There are also growing literature showing that you have very inelastic institutional investors, right? So when you have a very inelastic institutional investor and are faced with these flows from retailers, maybe there are not many, but they can have an impact because everything else is quite rigid. This paper by Van Berk and Jonin showing this in 2020 with Robinhood data. So I think it's kind of a new phenomena, and I don't think it's all the time. Also, again, the direction of this thing is not super clear, because you can say, okay, maybe what happens on the stock market has an impact on crypto, which is very important, but not the other way around. That's also possible. They see Tesla collapsing, they sell everything, right? So the causal link goes the other direction. So that's why I focus the paper really on cryptos, because I think that retail investors on cryptos, they plausibly have a large impact. And also everything you observe is very consistent with the price movements in crypto market over the past 2-3 years. Very, very much consistent, especially over the last year. While the other way around, I'm not sure yet about the answer. I hope I'll have a better answer in a few months with the follow-up paper.
So I had one general question about using the Kyle framework to think about pricing Bitcoin, and in particular thinking about how things change in your results when you remove the market segmentation. I mean, I guess the question is, who are the informed investors in Bitcoin? Like when we talk about pricing stocks, right? I kind of know somebody has information about future cash flows.
Absolutely.
I have difficulty translating that over a bit. How do you think about that?
I think I can make a very concrete example. So Bitcoin, as we said, the fundamental is derived, at least in theory we have so far, on transactional value. So you can use to pay things, right? So when Tesla, for instance, said, okay, we accept Bitcoin for buying cars, this is a huge impact on Bitcoin. But Tesla been building up the position in Bitcoin before saying it, and vice versa. They sold their position, then they said, oh, we don't accept it no longer. And the price collapsed. There was clearly, to me, an informed trade, right? If I do the same trade, nobody cares. If Elon Musk does it, or if you think of some BlackRock does it, or JP Morgan does it, that's the informed trade. Because by them buying it, they automatically change the fundamental value of the thing, because it's more likely a general adoption of the currency if you have these kind of big players inside. So there was a thinking of when I say informed. So I agree that the Kyle is easy, super easy on the stock market. I think it's harder on the crypto market, but I think there are good arguments, because again, if you don't have a market maker, but you have a continuum of small return is the same. Informed, I think that at least in this one example, it's clear what it is, and there are all degrees of these. I think I think overall is a good model for it because it's very easy in the mechanism, and it really highlights the specific mechanism I wanted to show in the paper.
Okay, I agree. That's a very nice example. I hadn't thought of that. Okay. Does anyone else have any final questions they want to ask? Okay, I guess we're right at the end time, so we'll go ahead and wrap up. So thanks very much to the presenters. Thanks for everyone for attending and for providing feedback. Please feel free to reach out to any of the presenters about what they've presented or anything else, and please take a careful look at their applications as they land in your inboxes. Finally, let me just advertise our next session is on November 18th, slightly earlier in the month because of the Thanksgiving holiday in the US. Tony Whitehead is presenting Will Central Banks Digital Currency Disintermediate Banks? I see that there's a new version on SSRN that was just uploaded today. And we've got Itamar Dreschler as the discussant. So I think that's going to be a really interesting session. Okay, thanks everybody, and we'll see you again next time.